Hi there traders, and welcome to the latest installment of the video blog. I hope it finds you well since we last spoke. Today's short video is going to be based on how to trade the markets when they go a little bit quiet and the volatility dies down. Purely because April was a tale of two halves, the first half of the month being pretty active, pretty volatile, lots of momentum and some good opportunities. However, the second half after the Easter break was very quiet indeed, and opportunities were pretty scarce, and it sometimes becomes a little bit difficult to know what to do when the market lacks that volatility. So just to give you a short update on what I do, what I tend to focus on when the markets go a little bit quiet, because when they're quiet, taking opportunities become a little bit more challenging, because as traders we absolutely need the momentum, we need the volatility to not only set up the trades but also to push them to profit, or even to push them to our stop loss, so we can then refocus and look for the next opportunity. So what I generally tend to do is I really focus in on one or two pairs that are really the standout from the crowd opportunities, and then look for multiple opportunities across that particular currency pair, be it a cross pair, for example. The example I'm going to use today is the Kiwi dollar. For me, the opportunity on the Kiwi dollar was a very, very strong opportunity in and amongst some very quiet markets and a lack of opportunities. The Kiwi dollar trade really stood out from the crowd, and what I then said to myself is, okay, we're very short of opportunities, but if the Kiwi is looking very interesting for a potential opportunity, there's going to be potential on maybe some of the Kiwi cross pairs, because if the Kiwi's relatively strong or weak, or any currency for that matter, then there's often opportunities on other currency pairs which include that particular currency. So I'm going to show you a couple of examples now to show you how I focus in on and take a couple of opportunities where the market may be not providing that many opportunities at all. Now, the Kiwi dollar opportunity was fantastic, and again, it's always nice to hear about you guys taking similar trades based on what you've learned over the last few months. So it's great that many of you took this trade because it was a standout from the crowd trade, a very high probability opportunity based on a number of different reasons. So let's have a look at this firstly. So the Kiwi dollar on the daily chart came back down to its 50 moving average, and most importantly gave us some very interesting stochastic divergence, as we can see here. Very, very clean, very, very obvious. So we topped out in the early part of April. The market came back down, had a very small retracement, very lethargic retracement, before then heading back down into the 50 moving average. Now, as we can see, if we're comparing the lows on the price action and comparing the lows on the stochastic, we've clearly got the opposite happening. New low on price, higher low on the stochastic. I don't need to reconfirm that. I think we all know what divergence is now and the powerful nature of it. So we saw the divergence, we saw a lovely level of support in the form of a 50 moving average, and also you've got your beautiful horizontal level of support here, where buyers came in on several occasions before and bought back in here, moved the market back up strongly, bought back in here at that horizontal level, pushed the market back up strongly, and then the market trickled back down and came back down beautifully. And what I like most about this is we've got double layer of support. We've got the 50 moving average and we've got the horizontal level of support. So it gives us that added confidence that this zone on our chart, this price point on our chart, is likely to give us a strong push back higher, so long as we've got the other supporting factors in place, which we absolutely did. We had the fib extension, we had the stochastic divergence, and most importantly for me is we had the strong price action. So this bullish low test reversal bar, quite small in size, which was again fantastic because it gave us a lovely reward to risk, because if this was going to head back up to its previous high, there was a good 3.5–4% reward to risk. That was another factor why this was a standout opportunity in and amongst the remaining opportunities that were available during the latter part of April. So this for me stood out from the crowd, gave us a lovely opportunity, triggered in, and the market has rallied strongly, and even rallied off the back of the positive non-farm payroll figure that we got on Friday. So this is looking ultra bullish. Friday actually posted a bullish outside bar, so this is looking ultra bullish. It's just hit 2%, so the stop can now be moved up to the 1% mark, and locking in a little bit more profit from the original position. And I expect this to go as a minimum to its previous high, which gives us the opportunity for another probably couple of percent. So if this pushes and takes out its previous high, it's going to be looking at a 3-4% trade. So I hope you caught this. For those of you that I haven't spoken to, I hope you managed to catch this, because this is standard technical analysis that I've been teaching over the last few months. Absolute screaming out of us that the market was going to head strongly higher. Fundamentally, the Kiwi is very strong, obviously, by just keeping an eye on the fundamentals. We've seen that the Kiwi has the Kiwi central bank has increased their interest rates twice over the last few months, so that's obviously strengthened the Kiwi against many other currency pairs. So again, the technicals aligning with the fundamentals, which gives added confidence in the trade. So a wonderful trade, still open. Let's see how far we can take the trade, and how much profit we can squeeze out of it. But I'm hoping that we can get maybe 3-4% from it by trailing our stop every percent that we make. So very nice opportunity there. I hope you managed to take advantage of it. If you didn't, then again, another great learning curve, because it's standard technical analysis which all came together at a very key point and followed through with its threats by heading much higher. So by observing the Kiwi, there wasn't really much else going on, so I was like, okay, if the Kiwi's ready to rally and head up strongly, it's likely to be strong against a basket of other currency pairs. So was there another opportunity on one of the cross pairs that included the Kiwi? This is what I do when the markets are relatively quiet, is I look for a currency pair which is massively strong or massively weak, and then look for other opportunities in cross pairs that include that particular currency. So there was one standout other opportunity that came about, and that was on the pound Kiwi. So we'll take a look at that now. So the pound Kiwi was an actual short trade, but this was playing on the fact that the Kiwi was strong versus the pound. So the pound was weak, relatively weak in comparison to the Kiwi. So we saw that the market had, since February, started its strong move down. So it topped out at the end of January, came down and started to put in lower highs and lower lows. But then the market bottomed out, as we could see with this key divergence around about the latter part of March. So we had a big strong move down. Latter part of March, it bottomed out and then started to head back up. Now, we're always looking for reference points, but even before that, we probably want to be looking for the price action anyway. So there's no point looking at reference points until the price action stands out and gives us a clue. And as we can see by this bar on the 29th, it was a huge high test seller reversal bar. So that was something quite interesting. After a massive buyer bar, we then get this humongous high test reversal seller bar. So the market then gave us a clue that something wasn't quite right here. This move up is actually looking like it could potentially move down again. What are we looking for? We're looking for our supporting factors. The price action on its own is never enough. It's a very, very powerful indicator of what's about to happen, but it's never enough. We need our supporting factors. So even though the market is threatening to head lower, we must look for our supporting factors. So if this market has been creating higher highs and higher lows, that's classification of an uptrend. So going and selling into an uptrend, we're ideally taking a reversal trade. The one thing that we need for a reversal is the stochastic divergence, which we get here. Beautiful higher highs on price, as we can see, a clear new high, but a lower high on the stochastic, threatening that this market is about to reverse quite strongly. And as we can see, this is making higher highs and higher lows, but it's pretty slow and pretty sluggish in comparison to the big strong move down. So really, this looks like it's just a bigger phase 2 in the major trend of this lower highs and lower lows. But for me, we are making higher highs and higher lows here, so we have to be aware that we are going against the current trend. So that's why we need that stochastic divergence. There is also a Fibonacci extension on this level here, so we can go from this peak here to this low, and it's given us it's poked up into the 1.618, so it's very overextended from its previous cycle. Again, another factor that gives us confidence that the market wants to move down, but the price action bar is giving me the most confidence. The market's had a huge buyer bar. Buyers have been heavily dominant, and then sellers have said, no, we're not going any further, we're going to start pushing this back down. What's it run into? No real moving averages, it's just crashed through the moving averages. It's not really historically been respectful of the moving averages, so I don't really pay too much attention to those. The fact that it's above them is neither here nor there, because the market in the past has paid no attention to it. So I'm looking for other levels of resistance to trade from. So as you can see, it's already marked on this horizontal level of resistance. We can see it was a strong level of support back in February. Broke through a little bit in January, but then was very respected in December. And if we go back further in time, respected last year October. So a pretty strong level. It's a soft level, but a pretty strong soft level of former support and former resistance, again becoming resistance. So again, nothing new here. All our factors coming together, all into one zone, giving us a clue that the market wants to head down strongly. So trading this on the breaks of the low triggered us in, and off it's running quite nicely. Again, playing on the strength of the Kiwi. By looking at the Kiwi versus the dollar and seeing how strong that was looking, we were then immediately looking for an opportunity on a cross pair where the Kiwi was either relatively strong or weak against another particular currency pair. In this case, because of the Kiwi posting a buy opportunity, it was the Kiwi strength. However, if the Kiwi had set up just as strong an opportunity to go and sell, I'd be looking at cross pairs where the Kiwi was weak against other pairs. So the first job is to pinpoint the standout opportunity when the markets are quiet, realize what it is, strength or weakness, and then look to play that relative strength or weakness against another currency pair via one of the cross pairs. Now, it may only be one other opportunity, and I do always recommend to people that if you are going to trade a couple of opportunities using the same currency pair, never more than two, because you are putting too many eggs in the same basket if you take 3 or more trades, which include the Kiwi, for example. So you're looking for a couple of opportunities when the markets are quiet to take advantage of those high probability setups, and then you're done. And then a couple of opportunities, if they squeeze out, like between these two, it's running at a 4% trade. Less is sometimes more. There's always this phenomenon that we have to, or this concept or this belief that we have to be trading a lot. The markets aren't always going to provide us with a constant stream. However, when the markets do go quiet, it's just our job to be a little bit more selective and to work a little bit harder to find that standout opportunity, and then to play that on a couple of opportunities. And then you'll probably find that the months that are quiet, you actually do better than the months that are a little bit more active, because we overtrade sometimes when the markets are very volatile and very liquid, because we get that fear of missing out. When the markets are running very strongly, we get that fear of missing out, and all of a sudden we start to jump into trades we know we shouldn't be in. When the markets are very quiet, it gives us that opportunity to take stock, to not have that fear of missing out, and to really focus in on one or two of the very, very best opportunities. And if you take a couple of trades in a month and are able to squeeze out 2, 3, 4%, that's not a bad return for the amount of time invested to get that return. So less is often more in the markets. So that's just a little technique, because I do get asked often when the markets go quiet. I do get quite a few emails of people saying, what do you do when the markets go quiet? And really, it's no more complicated than just focusing in on one currency pair where it's very strong, either very strong or very weak, and then looking to play that multiple times. So that's that. Hope that helps. And if you have been finding that opportunities have been a little bit quiet, especially in the second half of April, then don't worry. I've felt exactly the same, and that's sometimes a very hard thing to do, is to sit on your hands when there's nothing out there. But preservation of capital is just as important as growing your capital. So I hope that helps. And then finally, I just want to finish the video with looking at gold, because we have been monitoring gold in previous videos, and it's very, very interesting at the minute. From a technical standpoint, very, very interesting. It's given us all number of things in terms of technical clues. Now I'm just going to clear my chart so I can get rid of all these lines, so I can clear it up and we can go back through the analysis, because it is very, very interesting, and I am interested in looking to trade it very shortly. So everyone remembers the buy opportunity we took back in December based on this ABCD pattern. So A to B, B to C, C to D, and that lovely divergence trade, bullish bounce off this level of support, which then gave us that 1,000 pip return. Absolutely fantastic. Now, we've had this strong move up, which for me has turned this big downtrend into an uptrend, because that's a phenomenal move back up. So we've had this big push back higher, and this healthy retracement, which I see is just really profit taking, because when you get up here, people have said to themselves, I've got a lot of profit on the table, let's take some profit off the table, and the market's come back down. And that's when we looked at it in the last video, I believe, and I said what I'd like to see is a push higher followed by then a further push down to give us divergence. Surprise, surprise, what has happened? Big push up, big push down, and we've got this divergence. Absolutely phenomenal how the markets just tend to do exactly what you expect them to do. And when they do that, the confidence that it gives you is phenomenal. So this was actually a retracement, I think the 50% retracement. I was hoping it was going to come down to the 618, but it was actually just turned down to the 50%, because the 618 corresponded with a very significant level of previous resistance and support. So a very nice horizontal level there. So into this zone here, which price pushed down into, and then we were looking for a reaction. Well, the first thing we got was the stochastic divergence, new low formed, followed by a higher low on the stochastic divergence. And then did we get a reaction? Yes, we did. We got that huge reversal bar on the 24th. So a huge outside bullish buyer bar. It triggered higher, and then the market retraced during the whole of last week before the non-farm payrolls came out, and the market responded strongly by then finishing as a bullish outside bar. So I'm very interested in, even though it didn't quite come down to my level, I'm very interested in contemplating in taking this next week if we break the highs of this bar here. Now I still need to do a little bit more analysis, because I was hoping it was going to drop a little bit lower, but what I might do is just have quite a wide stop loss just tucked underneath this level here, because if we are going to get another move like we did from the bottom here, so if this was another ABCD pattern, A to B, B to C, C to D would be topping out around about the 1479 level, which gives us the potential of another just under 2,000 points or pips. So looks very interesting indeed. Had a healthy retracement. If this is going to start its next surge up, then there is potential of a very healthy reward to risk indeed. Now, aggressive approach would be to get in on the break of the high. Conservative approach would to be waiting for the first higher high. So if this takes out its previous high, let's just zoom in a little bit more. So it's put in a higher low. So we've put in this higher low just here because it's higher than its previous one. If it breaks this previous high here, let's put in a higher high, and then looking really for the first pullback and retracement to then get in onto the next leg higher. So you'd be looking for it to break the highs, give us another phase 2, and then be looking for an opportunity to get in on the phase 2. Aggressive approach just be to get in on the break of the high Friday. Quite a conservative stop underneath the 618 level. Or conservative would be to wait for it to break the high and give us that nice phase 2 pullback, and then look for your bullish buyer bars to then get back in on the next leg up. But if we are about to get another strong phase 1, then the potential of a nice healthy healthy reward is looking very good indeed. So that's gold. Very interesting, and just nice to be able to. It'd be funny for you to actually go back and listen to the video. I can't remember which one it was, but we did actually say, because when we got price all the way down here, we didn't have any divergence. So when it popped back up, I was thinking to myself, to get divergence, we must have another push lower. So when it pushed all the way down and gave us a new low but a higher low, I was like, perfect. Now we're seeing divergence. Now it's giving us further confidence that a reversal from this push lower is about to happen. So thus the reason why it's looking very interesting indeed. Why else is it looking interesting? Well, we've got other patterns in and amongst everything. Well, if we just take these off again to clean the charts up, I'll show you what I mean. So head and shoulders pattern is a reversal pattern as well. So we look like we've got the left shoulder there, and then we've got the head just here, and then we've got the what looks like the formation of the right shoulder just there. Not a perfect pattern, but left shoulder, head, right shoulder. If this is the right shoulder, then this is the start of the next strong move higher. So that's a mini head and shoulders reversal pattern, head and shoulders bottom. So we also have a much larger version of this pattern. Let's just have a quick look at that if we zoom out, which is very interesting as well. So as you can see here, big move down, looks like the left shoulder, big push up, big move down, the head just here, big push up, big push down. This looks like this is the right shoulder of the bigger pattern. So lots and lots and lots of factors all coming together. We've got some small patterns, we've got some larger patterns, we've got some lovely divergence, we've got some horizontal levels, we've got some Fibonacci retracements, we've got an abundance of things all pointing to a move higher. Is there a guarantee that it's going to have this same move up? Absolutely none whatsoever. Is there a high probability of it doing that? Absolutely. Do we want to trade high probability? Yes, we do, time and time and time again, because that will give us our edge. That will mean that most of our trades will work out, and the ones that do give us a nice, healthy reward in comparison to the risk that we have. So that's a nice, interesting one to go through, and again, have some time over the weekend just to have a play around with your trend lines, with your lines, with your Fibonacci, with your patterns, because this is great. It's got an abundance of things to really hone your skills on, and then look for some opportunities over the next few days and weeks to see if you can take advantage. And as we saw here, we got lots of pullbacks. So if you don't get the opportunity initially, look for those pullbacks on the way up, because it's going to climb the stairs. It's not just going to go up and up and up. It's going to pull back at times, and that's when you want to be looking to enter into that opportunity. So that's the video wrapped up. I will leave that with you. Have a great trading week. We have a bank holiday in the UK on Monday, so the markets may be a little bit quiet on Monday, but come Tuesday we should have the return of the traders and the return of the volatility and the momentum, and let's really get May off to a great start. Cheers guys, all the best, bye.